All right, and we're ready for part two of our three video series on real world client stories from out here in the field. If you didn't watch part one, we're doing a short three video series where Derek and I, we've talked to, we don't even know, but it's tens and tens of thousands of people. We've helped many thousands of people apply and get approved for long-term care. And so we just want to tell some real stories to get people thinking about how to plan for this. So I'm Drew with LTC Tree here with my cousin Derek over in Atlanta. Hey Derek.
Hey Drew, how's it going?
It's going great. Yeah, let's dive into what can people do if maybe they've waited a little too long and they apply. I just had a client, he applied for three different companies, which we do for people if they're kind of on the border, and all three declined him. That's what we're going to talk about.
Yeah, so there is a solution, thankfully. So, when you have health issues, as long as you're not currently needing help with your activities of daily living, and those are eating, bathing, dressing, toileting, transferring, maintaining continence, as long as you're independent and don't need help with those, or physically living in an assisted living facility or living in a nursing home, there is a solution that we're using. It's kind of a self-insure play where you can use lifetime income annuities with a long-term care feature. And so, Drew, how exactly do these long-term care annuities work?
Yeah, so the key here is if you are imminently needing long-term care, so let's say you're not in the assisted living, but you're kind of seeing the writing on the wall that you're probably gonna need to go in about a year or so, still, these aren't a good fit. But if you're planning for 5, 10, 15 plus years into the future, these are great. So the way they work is you pay a single premium currently. So you put a lump sum into one of these policies and then you defer. Now, you don't have to pick how many years you're going to defer right now, but the more years you defer, up to 20 years, the income stream that you can turn on increases by a 10% simple and 8% compound. There's various versions of these out there, but essentially the longer you wait, the higher the guaranteed lifetime income that you get will be. Now, let's talk about the long-term care specific part, Derek.
Yeah, so whatever premium you put in, there's various products out there. Some will give you an 8% compound, some will give you a 10% simple interest. But the more years you defer, you bank, in that example, 10% simple interest each year for as long as 20 years. So going back to your point, Drew, the more years you defer, the higher that income base becomes. And so at a certain point, you're going to turn on the lifetime income. Now, this could be not just for long-term care. This is just almost like an extra pension. It's going to pay you X number of dollars for as long as you live. If you ever need long-term care, and they define that as needing help with 2 of 6 activities of daily living, they then give you a 100% bonus on that income for 5 years.
So to give a real world example using current numbers, someone who's in their early 60s, they might put in, say, $200,000 in premium into one of these vehicles. It's going to set up an immediate benefit base of $240,000 because there's a little bit of a bonus they give you to help people that might be moving from an older, less lucrative annuity, or if it's just cash coming out of the market, it's just a nice little bonus. So if you wait 10 years, you've got a $32,000 per year income from that $200,000 premium. And that's doubled if you need long-term care. So let's say you wait 10 years and it's like, wow, I might need long-term care. They're going to turn on the $64,000 a year for 5-year income stream. Now, if you get better, or even if you still need long-term care, but you're still alive after 5 years, it will revert back to the $32,000, but it will last for the remainder of your life.
So it's almost, in essence, like an unlimited pension, or that has a long-term care component, because it has to pay that for as long as you live. So, Drew, what happens if, say, they put the money in, they never touch it, and they just die? Do they lose the premium?
No. So there's a death benefit, which is actually higher than premiums paid in almost every year, that will be paid to your beneficiary. The other thing you can do, and you don't have to opt for it when you purchase this, but you can set it up with joint lifetime income. So if you have one healthy spouse and you want to protect the less healthy spouse who may need long-term care, perhaps they have a chronic condition, you can actually set up joint income to where both of you can receive that income for both of your lives. Now, there's a pro and con with everything. If you do that, it will reduce the amount of income that you get for long-term care. You still get a 50% bonus, with most of these plans. And, there's a lot of specifics in the specific plan you're looking at, but it's a really nice way to, like you say, guarantee that income, almost like a pension.
Yeah. Well, we're LTC Tree. We're a broker. We work with every single company out there. So we help our clients shop the market and figure out which company has the best combination of benefits for their specific needs. So if you'd like to learn more, go to ltctree.com/quote, fill in a form, or call us 1-800-800-6139. It's often Drew or I will pick up.
Exactly. So thanks for watching part 2 in our 3-video series on real client stories. If you think you might be declined or even have been declined for one of these policies, let us know. We've helped dozens of people flip from declined to covered here in this 2025.
All right. Thanks, guys.